Gold recently hit an all-time high, just this year in fact. And if you've been on social media lately, you've probably seen ads, headlines, maybe even a family member that's telling you it's time to buy gold. So today, I want to do something a little different. I'm going to take you through my actual take as a financial advisor on whether gold belongs in your portfolio and some of the ins and outs. There's no sales pitch, no affiliate links to gold companies, just an honest breakdown of what gold actually does, how it works, when it makes sense, and when it doesn't. Before we dive in though, a quick introduction so you know who I am. Hey everybody, my name is Faustino Munoz, and I'm a financial advisor. I hold the Certified Financial Planner, or CFP designation, along with the Behavioral Financial Advisor, or BFA certification. At work, in my day-to-day work, I help individuals and families to make smart and tax-efficient decisions when it comes to their retirement and investment strategies, especially when things begin to get more complex as they plan for future financial goals. Before we really talk about whether or not you should buy gold, we need to talk about why people buy it in the first place. Because there's a few reasons, really mainly three, and each one leads to very different results and conclusions in a portfolio. The first reason is as an inflation hedge. The idea here is that gold holds its purchasing power over time. If the dollar loses value, gold goes up. Historically, there's some truth to this, but it's messier than commercials and TV and sound bites make it sound. Over short periods, it can actually move in the opposite direction of inflation. So therefore, it's a rough hedge at best, which is good. Reason two, as a safe haven asset. See, when stock markets crash, people flock to gold. We saw this in the 2008 financial crisis and again in the early COVID days. It does tend to hold up or even rise when equities are falling. So this is the strongest argument to have gold inside of a portfolio. The third reason is for speculation. Let's be honest, a lot of people buying gold right now are buying it because it went up and they think it's going to keep going up. That's speculation, not investing. And there's nothing wrong with making a speculative bet, as long as you know what you're getting into and what you're doing. The problem is that most people buying gold today are mixing all three of these reasons together, which can make it really hard to evaluate whether it's actually right for them. Okay, let me steelman this gold argument, because there are legitimate reasons an advisor might recommend a small or sizable gold allocation in your portfolio. The first one is for portfolio diversification. See, gold has a low correlation to other stocks and bonds. That means when your portfolio is zigging, gold often zags. Adding an asset that doesn't move in lockstep with everything else can actually reduce your overall portfolio volatility, even if gold itself can be volatile. Research generally supports a small gold allocation, somewhere in the neighborhood of 5 to 8%, specifically for this exact diversification benefit. The second one is for geopolitical uncertainty. We're living in a world right now with elevated geopolitical risks. There's wars, trade tensions, currency concerns, and gold has historically been a store of value that transcends one country's monetary policy. And here's a number that I think a lot of people may not know. Central banks around the world collectively bought over 1,000 metric tons of gold each year, 2022 through 24. That's gold that's being purchased by the very institutions that manage national reserves. That number did dip some in 2025, with them only buying 863 metric tons of gold. China, Poland, Singapore, they've all been adding gold meaningfully for several years now. When institutions that sophisticated are buying in large quantities, it's worth at least asking why. Here's a chart to show central bank purchases and sales of gold in metric tons over the last few years. The third is for long-term price appreciation. See, gold was about $35 an ounce in 1970 when the US came off the gold standard. It's been above $4,600 an ounce recently. It's a 131-fold or increase over the last about 55-year period. But the S&P 500 has done better in that time. We'll get to that though. So don't let anybody tell you that gold has been a bad long-term asset. The appreciation has been real. So the case for gold is real. I'm certainly not dismissing it. But here's where I have to be honest with you about the limitations of gold, because the gold industry is very good at marketing. Some of the arguments that you hear out there, they're misleading. See, gold doesn't produce income. Stocks pay dividends and companies do. Bonds pay interest. Real estate can generate rent. Gold just sits there. The only way you make money on gold is if someone pays you more for it later than what you paid for it originally. So here's how the long run math actually looks. If you had put $10,000 into the S&P January of 1970 with dividends reinvested, it'd be worth in the neighborhood of $3.1 million today. That's roughly an 11% annualized return. Even if you didn't decide to reinvest those dividends, the value of that original 10K would still be about $737,000 today, about an 8% return. But that same amount in gold in 1970, again worth about $35 an ounce, you would have been able to purchase about 285 ounces. So today's price and value would be about $1.13 million. Still a very significant gain, but it does fall short of equity returns. Warren Buffett has made this exact argument for decades, and the numbers back him up. See, timing is brutal when it comes to gold. It can go years, sometimes even decades, without going anywhere. From 2012 to 2018, gold basically flatlined. If you bought it at the peak of 2011, that timing, thinking it would continue to go up, you would have had to wait a decade for it to break even. People buying gold right now because it's at an all-time high need to understand that they may be buying at the top of a cycle. And I also want to make sure to bring up the fee trap when it comes to gold, because this one here really bothers me. People are out there getting taken advantage of regularly. If you buy gold through a reputable ETF, the costs are low, and I'll get into those specifics in a minute. But if you buy physical gold coins or bars from one of those companies that advertises heavily on YouTube, talk radio, or cable news, you can easily pay 10 to 20% above the spot price of gold just in markup. Spot price today is roughly $4,600 an ounce. So a 15% markup means you're paying $5,290 for something worth $4,600. Then add storage and insurance costs of hundreds of dollars a year for a home safe or private vault, and you've got a significant headwind before you've even started. You'd need gold to rise meaningfully just to break even on your fees for that gold. This is the section that I really want to spend some time on, because I get questions about this constantly. People are always asking, can I hold gold inside my 401k? Can I put it in my Roth IRA? What's the right way to do it without paying insane and outrageous fees? Well, the answer is yes. And for most people, this is by far the best way to get some gold exposure in your portfolio. Let me walk you through your options. Option 1, purchase gold ETFs in a brokerage account or an IRA. See, an ETF, or an exchange-traded fund, it's just a fund that trades on a stock exchange. Trades just like a regular stock. Gold ETFs often hold physical gold in a vault, and when you buy a share, you're then buying a fractional claim on that gold. You never touch the physical metal, you never store anything, you just buy and sell shares in your brokerage account just like you would any other stock out there. Two of the most common and most popular options out there are GLD and IAU. GLD, that's the Spider Gold Shares ETF, is the oldest and the most traded. Has around $184 billion in assets. Its annual expense ratio is 0.4% per year. That means on a $10,000 investment, you'd be paying about $40 in annual fees. It's a very reasonable figure. IAU, that's the iShares Gold Trust, is a bit smaller, but has an even lower expense ratio of just 0.25% per year. On that same $10,000, you're only paying $25 a year. It tracks the price of gold almost identically to GLD. Another one out there is IAUM, which is a newer iShares product with an expense ratio of just 0.09%, essentially negligible. It's a smaller fund which has less trading volume, so the bid-ask spread can be a little bit wider, but for a long-term buy and hold investor, that's really not a big concern. I want you to know the options that are out there and available for you. Now, here's the key thing. You can hold any of these inside of a traditional IRA, a Roth IRA, or a regular taxable brokerage account. Most brokerages, Fidelity, Schwab, Vanguard, E-Trade, they'll let you search for these tickers and buy them just like any other investment or stock that you or your advisor can purchase in your account. There's no special account needed to do this. If you have an IRA at any of these brokerages, feel free to log in now. You can add a gold ETF anytime alongside your existing funds and investments. Option 2 then would be to purchase gold mutual funds. Some investors prefer mutual funds over ETFs. Maybe your 401k doesn't offer access to ETFs, or you prefer the automatic investment structure of a mutual fund. Well, gold mutual funds exist, but I want to be honest. The most common ones out there are gold mining stock funds. They're not gold funds themselves. A fund like VGPMX, Vanguard's Precious Metals Fund, invests primarily in gold and silver mining companies, not in physical gold. Mining stocks can actually be more volatile than gold itself. And when gold goes up 10%, mining stocks may go up 20%. But then when gold goes down 10%, mining stocks can drop 30 or 40% even. It's an amplified, riskier bet for sure. It's not necessarily bad, but you need to understand what you're buying, what you're getting into. If you want the exposure to the price of gold, stick with a physical gold ETF. If you want a higher risk, potentially higher reward play on gold, then mining stocks or mining funds might be your vehicle. They may be the best fit for you. Another option is to get gold in your 401k. See, but this is where things can get a little bit trickier or a little bit more nuanced. Most 401k plans have a limited menu of investment options. They're set by your employer and administrator, and most of these do not include a physical gold fund. You're typically choosing from a handful of stock funds, bond funds, target date funds, and oftentimes there's maybe a stable value option available for you. However, some 401k options and plans out there may include a precious metals fund or a commodities fund in their lineup. It's worth today trying to log into your 401k account, doing a quick search to see your options available. If it's there, wonderful. Then feel free to allocate those dollars there. If it's not, and for most people it won't be, there are still a couple of workarounds. Make sure you're contributing enough to get the full employer match, if available, in your 401k. But then for any additional retirement savings, feel free to use a separate IRA where you have full investment flexibility. That's where you'd hold your 2 gold ETFs if you want. Another option then is if you have an old 401k from a previous employer, well, rolling it over to an IRA gives you that same flexibility. I actually did an entire video on 401k rollover options. Feel free to head over to my channel to check that video out. Physical gold, however, held outside of something like that, by contrast, is taxed oftentimes as a collectible at a maximum rate of 28%, which is higher than the standard long-term capital gains rates of 15 or 20%. See, there's a separate option available called a gold IRA or a precious metals IRA. That lets you hold physical gold inside of an IRA. Those products exist, they're legal, but they can come with significantly higher fees, often setup fees, annual custodian fees, and storage fees. These are aggressively marketed by some of the same gold companies that I mentioned earlier. For most people, however, a simple gold ETF or mutual fund inside of an IRA is a better and cheaper way to get the same exposure to gold today. So what should you actually do? Well, here's my take. And again, this is general guidance and thoughts, not personalized advice for your specific situation. Today, if you have no gold exposure, a small allocation, maybe between 3 and 5% of your portfolio, certainly not unreasonable if it helps you to stay diversified and to sleep good at night. I'm not opposed to it. But I also wouldn't prioritize that over maxing out your 401k or IRA or building up an emergency fund or paying down high interest debt. Those should all come first. If you do want to add gold today, the cleanest way is to do it through a low-cost ETF, like one of the ones I mentioned earlier, or there's a few others out there. These give you exposure to the price of gold without the hassle of storing and moving the physical metal. Some of these in particular have very low expense ratio. And I'm really not being paid to say any of these about those funds. They're just some of the most cost-efficient ways to get gold exposure today. And if someone out there is pressuring you to buy physical gold coins or bars, slow down. Ask what the premium over the spot price is. Ask about storage and insurance costs. Ask what the liquidity looks like when you want to sell, if you want to sell. A reputable dealer will answer all of those questions very clearly. If they're evasive or give non-answers, walk away. And if you're thinking about putting a large chunk of your savings into gold today, into gold right now, because it's near an all-time high, I want you to really think about that. Because buying high is how people get hurt. If you want exposure, dollar cost averaging in over time rather than going all in at a price peak may be better for you. And that's true of any investment, but especially one that historically has shown the kind of decade-long flat periods that gold has. So, should you buy gold right now? Well, my honest answer, maybe a little, if it completes a diversified portfolio. But I would not be chasing this rally, or any rally. And I certainly wouldn't be putting money that you can't afford to lose or see drop into gold simply because a commercial told you your retirement is at risk if you don't, or buying physical gold coins or bars because a TV commercial told you that the dollar is collapsing. Those kinds of things I'd push back on for sure. See, especially today, gold is a tool. And just like any other tool, it's useful in the right context and harmful in the wrong ones. The best financial decisions are not made because of fear or FOMO. They're made based on your goals, based on your timeline, and your overall financial picture. So if you've never sat down and maybe mapped out your actual asset allocation, what percentage is in stocks, bonds, real estate, cash, alternatives, that's probably a better use of your time today than buying gold right now. So if you found this video helpful, please subscribe and like this video. I put out a new video every week on topics just like this. Real financial questions, real financial topics, all from an advisor's take. If you'd like to dive deeper into any of the topics that I've covered, please click the link in the video description below. You can schedule the time directly with me. I'm always happy to connect, always happy to chat. See you all next week.